Welcome to the debate. Today, we're unraveling a really fascinating dilemma right at the heart of traditional finance. It concerns the S&P 500's recent decision not to include MicroStrategy, a company whose identity, let's be honest, is now almost entirely tied to Bitcoin. It was a decision that definitely left many scratching their heads, especially since MicroStrategy or MSTR seemed to, check the boxes for market cap, and it's certainly generated a lot of market attention.
Absolutely. It's a key moment, I think.
It is. And the central question we're going to explore is this. Does MicroStrategy's exclusion from the S&P 500 primarily stem from its, let's say, inherent operational structure and transparency issues? Or is it really more a reflection of traditional finance just being reluctant to embrace these novel Bitcoin-focused business models? So I'll be arguing that, MicroStrategy's model and its disclosure practices were the main disqualifiers.
And I'll be taking the position that while those points have some merit, the rejection points to something, bigger, a kind of systemic resistance within traditional finance to entities like this, especially those centered on Bitcoin. It's a fascinating development, and I'm definitely eager to delve into it from that angle.
Indeed. So my perspective is MicroStrategy's rejection from the S&P 500, it's largely a direct consequence of its, unique operational structure and, frankly, a clear lack of adherence to traditional financial disclosure standards. Fundamentally, MicroStrategy operates less like a typical tech company and, as many have pointed out, much more like a closed-end fund, or CEF for Bitcoin. An investment company holding a fixed portfolio, not running a core business. And those types of entities, they are explicitly excluded from the S&P 500. That's just part of the design. Its value is overwhelmingly correlated to Bitcoin's price movements, not the performance of its, original software business. That's a critical distinction, I think. And it goes against the very spirit of what the S&P 500 is supposed to represent. Now, beyond this structural issue, the company's rather opaque Bitcoin custody arrangements and the CEO, Michael Saylor's, refusal to disclose specific addresses, that creates significant transparency issues. There's this inconsistency, right? Trying to speak to Bitcoiners in their language of sovereignty, while also trying to look compliant to traditional finance, but without offering real clarity. That inevitably breeds mistrust, both from regulators and investors. For the S&P Index Committee, inclusion is ultimately about risk-adjusted consistency, and Bitcoin exposure without clear product-market fit or the necessary transparency, that's naturally going to be viewed as a liability, not an asset, when you're considering a company for such a, prestigious index.
Okay, while I acknowledge that view, the picture looks quite different, I think, when we consider the larger context. MicroStrategy's operational model certainly has its unconventional aspects, I won't deny that. But its rejection from the S&P 500 points to a deeper, maybe more systemic issue. Traditional finance's inherent gatekeeping and, frankly, resistance to fully integrating truly innovative Bitcoin-centric entities. Look, the S&P Index Committee, even when a company meets quantitative requirements like market cap, they retain subjective discretion. And this allows for, subjective reasons like high volatility or concentrated ownership or even the perceived risk to mom-and-pop retirement funds to be used as grounds for exclusion. Even if, let's be fair, similar arguments could be made for many high-growth stocks already in the index. This points directly to what I see as a kind of cultural or prestige gatekeeping.
It genuinely feels like Bitcoin companies aren't welcome yet, or, as some have put it, quite bluntly, they don't want to let the Bitcoin kids sit at the grown-up table. And you know what? This sentiment aligns perfectly with Bitcoin's whole underdog story and the frankly expected resistance from legacy systems. MicroStrategy's approach of straddling Bitcoin maximalism, that strong belief in Bitcoin alone, and traditional finance inclusion, in this context, it's ultimately deemed unacceptable by the established order, regardless of its technical merits on paper. The issue isn't simply about what MSTR is, it's about what it represents to a system that, let's face it, struggles with genuine disruptive innovation.
I appreciate that framing, but let's really dig into the core of MicroStrategy's business model. You characterize it as an innovative approach to corporate treasury, but the evidence, I think, strongly suggests it has fundamentally transitioned into what I'd call a Bitcoin fund in disguise. Its stock performance is just inextricably linked to Bitcoin's price, consistently overshadowing any real performance of its original software business. This deviation from the typical operating company model is, in my view, a primary disqualifier. The S&P 500 is designed for companies with, established product market fit, stable revenue streams, not for vehicles whose primary value proposition is simply exposure to another asset. The material itself even suggests the whole Bitcoin treasury company model is potentially flawed and overheated. That seems to reinforce the S&P's decision. It's really a matter of categorization and the established purpose of the index, which is fundamentally to track operating businesses.
Okay, that's a compelling point about categorization. But have you considered that framing it solely as a fund might oversimplify the strategy, and it potentially ignores the possibility of integrating digital assets into corporate treasuries in a genuinely innovative way? Maybe the issue isn't the model itself, but traditional finance's reluctance to acknowledge and adapt to these new business paradigms. I mean, if the S&P's criteria are so rigid that they just cannot accommodate an innovative approach to corporate treasury management, doesn't the index itself risk becoming stagnant, unrepresentative of evolving economic landscapes? Are we really saying that no company can innovate with its treasury without being basically shunted into a different category just because it doesn't fit a historical mold? Bitcoin is a new asset class, and, well, new business models are naturally going to emerge around it.
I understand the desire for innovation. I really do. But for a benchmark like the S&P 500, which serves as a proxy for the broader economy for millions of investors, blurring those lines between an operating company and an investment vehicle, it introduces significant risk and, honestly, confusion. If a company's primary driver is a highly volatile, largely uncorrelated asset, rather than its core business operations, how does that serve the index's purpose, which is meant to represent stable, productive enterprises? It essentially risks turning the index, or parts of it, into a speculative bet on Bitcoin, which is just not its mandate.
Right, but isn't the S&P's mandate also to reflect the leading companies of its time? If innovative treasury management, maybe incorporating a new asset class like Bitcoin, becomes a hallmark of future successful businesses, then by excluding MicroStrategy purely on this fund in disguise argument, isn't the S&P risking falling behind? They seem to be defining innovation based on existing rules rather than adapting to how innovation actually manifests in the real world. The question isn't whether it's exactly like a traditional company, maybe it's whether it's a leading company in a new paradigm. And shouldn't the S&P aspire to represent that?
Okay, well, beyond the structural issues, let's look at the critical aspect of transparency. Because innovation surely must still operate within a framework of clarity and accountability. Especially for an index representing such broad investment, the refusal to disclose specific Bitcoin addresses or provide clear custody arrangements, that's frankly a non-starter for any institution aiming for S&P inclusion. This lack of transparency, it directly contradicts the foundational expectations of traditional finance regarding accountability and investor protection. Regulators, investors, they need clarity to assess risk. And MicroStrategy's approach, well, it fosters mistrust. For any founder hoping for S&P inclusion, the source material is quite clear on this. Custody, transparency, and regulatory clarity are non-negotiable. This isn't some unfair demand, it's a fundamental standard for trust in established markets.
I'm sorry, but I just don't buy that it's simply about standards when applied perhaps selectively. While transparency is undoubtedly crucial, we have to consider the context of Bitcoin itself, where self-custody, directly holding your own keys, not using a third party, and privacy are core tenets for many people in that space. This inconsistency breeding mistrust you mention, could it be exacerbated by traditional finance's own unfamiliarity with these decentralized practices, rather than just outright intentional obfuscation by MicroStrategy? Is the demand for traditional disclosure methods genuinely just about assessing risk, Or is it also an attempt to force, a square peg into a round hole, thereby penalizing companies that actually embrace Bitcoin's native characteristics? From a Bitcoiner's perspective, the advice often is, shouldn't rely on TradFi systems for validation. And this kind of resistance to unique disclosure approaches only reinforces that exact sentiment.
I understand the philosophical stance of some Bitcoiners, I do. But the S&P 500 operates under a different set of expectations, particularly for the diverse investor base it serves, including many retirement funds. How can the S&P Index Committee possibly fulfill its fiduciary duty to millions of investors if it cannot definitively verify the assets a constituent company claims to hold? Or, just as importantly, how securely those assets are managed? This isn't about rejecting Bitcoin's philosophy. It's about adhering to the practical, verifiable standards of accountability that traditional finance demands for investor protection. There simply must be some common ground for audibility.
But what if that common ground needs to, evolve? The very nature of Bitcoin allows for verifiable proof of reserves through things like cryptographic signatures, without necessarily disclosing specific public addresses, which could compromise security or privacy. Couldn't traditional finance adapt its auditing methodologies to these new digital asset realities, instead of just demanding a one-size-fits-all approach designed for legacy systems? It feels like a missed opportunity, perhaps, for the S&P to innovate its own standards for a new era of digital assets, rather than simply, shutting the door.
Okay, that brings us to the broader implications for this whole new class of Bitcoin treasury companies. Is this model genuinely viable, or is MicroStrategy an outlier and the S&P's decision actually a valid assessment? The material we looked at clearly states that the hype around Bitcoin treasury companies is overheated, and quite unequivocally, holding Bitcoin equals good business model. We've seen examples, right, like Naja, which dropped significantly after its Bitcoin play, and Semler, Bitcoin Well. They seem to be struggling despite their Bitcoin exposure. These cases, I think, underscore my point. These companies often lack fundamental business models beyond the Bitcoin holding. The S&P's decision, therefore, serves as a kind of validation that a company needs a real product service plus a Bitcoin treasury, not just a speculative vehicle whose main function is giving exposure to another asset. That seems like a crucial lesson for founders. Build a genuine business, something with a tangible product or service, not just a Bitcoin holding company if you're seeking that mainstream financial integration.
Yeah, I'm just not convinced by that line of reasoning, because while some Bitcoin treasury companies may certainly lack strong fundamentals, I'll grant you that, generalizing this critique to all such models might be premature. The S&P's decision could just as easily be seen as an institutional attempt to maybe stunt innovation rather than a pure, objective assessment of business viability. It feels like a selective application of critique that conveniently ignores potential. And furthermore, consider the market reaction. Bitcoin didn't flinch on the news, really. And MicroStrategy's stock drop, it was not catastrophic, something like 3%. That indicates, doesn't it, that for the Bitcoin community at least, this kind of resistance from legacy systems is basically anticipated. It doesn't really diminish Bitcoin's long-term ethos of decentralization and self-sovereignty. The market's reaction almost suggests that the market doesn't care, and neither should Bitcoiners, about this particular form of TradFi validation.
But for an index whose purpose is providing broad market exposure, the Bitcoin community's sentiment isn't the sole determinant, right? It's not even the primary one. The S&P Index Committee has to consider the broader implications for the hundreds of other companies in the index, for the millions of traditional investors relying on it. If a significant constituent is driven almost entirely by the volatility of a single digital asset without a robust underlying operational business, well, that introduces an unpredictable element. It compromises the index's integrity and its representation of the actual economy. It's about more than just MicroStrategy's individual stock price performance on a given day.
Yet if the S&P index is meant to be forward-looking at all, shouldn't it consider emerging economic realities, even if they're still, nascent? To dismiss the market's relatively calm reaction as totally irrelevant seems like ignoring a signal that this model, even if unconventional, holds some legitimacy, at least in a different sphere. The S&P risks being seen as a lagging indicator if it's too slow to adapt its criteria to companies embracing new financial paradigms, regardless of whether Bitcoiners themselves care about being in the index or not. It really highlights this tension, doesn't it, between traditional stability and the need for future relevance.
I see why you think that, but ultimately, the S&P Index Committee's primary role is selecting companies that represent stable, risk-adjusted investments for a broad spectrum of investors, including those mom-and-pop retirement funds. MicroStrategy's high volatility, the unclear business use of Bitcoin beyond storage, these are legitimate concerns that the committee is specifically designed to address. This isn't about resisting innovation just for the sake of it. It's about protecting the integrity and the stability of the index. It's about maintaining established standards for what constitutes a reliable constituent of a major market benchmark, which, let's not forget, serves a fiduciary duty to millions.
That's a compelling argument regarding fiduciary duty, absolutely. But the black box nature of the committee, their deliberations aren't accountable, and what's been termed the "you're not in the club" phenomenon, this perceived resistance to entities that just don't fit the established norms and networks within traditional finance, well, it suggests that while risk assessment is a factor, maybe an element of cultural bias against these novel Bitcoin kids plays a significant role too. The provocative idea floated in the material that maybe S&P needs MSTR more than MSTR needs S&P, that highlights a potential missed opportunity for the index to actually reflect evolving financial realities. This decision could easily be interpreted as a rigid adherence to past paradigms, overlooking the long-term value and potential of new asset classes and business models, and thereby potentially making the S&P less relevant over time to a changing economic landscape.
Okay, while the S&P's committee process might be opaque, its decisions are generally understood to uphold specific criteria. They prioritize established business models, consistent revenue streams, verifiable assets. To argue that the S&P needs MSTR suggests the committee should somehow compromise its fundamental principles just for the sake of appearing innovative or maybe relevant to a niche. Its role is to be a reliable benchmark, not, a venture capitalist. If the criteria are clear, even if the exact weighting isn't fully disclosed, the onus really has to be on the company to meet them, not for the S&P to start bending its own rules.
But is it truly about bending rules, or is it about recognizing that the rules themselves might need to evolve to remain reflective of the leading edge of the economy? Historically, major indices have adapted to include new industries, think railroads, then technology. If the S&P rigidly adheres to definitions that end up excluding entire categories of innovative companies, particularly those leveraging transformative technologies like Bitcoin, doesn't it risk becoming a bit of a historical artifact rather than a true representation of market leadership? This decision, I think, could be seen as a bellwether for how quickly traditional finance is willing to embrace the future, or perhaps how stubbornly it might cling to the past.
So, to sum up my view, MicroStrategy's exclusion from the S&P 500 appears largely a direct consequence of its unique operational structure, very closely resembling that closed-end fund for Bitcoin, and its pronounced lack of traditional financial transparency, particularly around Bitcoin custody. These factors, they directly conflict with the S&P's foundational mandate for risk-adjusted consistency, and they really highlight the imperative for companies seeking that kind of inclusion to possess a robust, traditional business model, distinct from just asset exposure, and crucially, to adhere to a high degree of transparency.
And from my perspective, while MicroStrategy's structure and disclosure practices certainly played a part, its rejection also points to a deeper, perhaps systemic resistance within traditional finance, a reluctance to integrate entities that are fundamentally tied to Bitcoin. The subjective nature of the S&P's black box committee, that pervasive, not in the club feeling, it suggests a hesitation to welcome new paradigms. And this only reinforces the Bitcoin community's long-held belief in the asset's decentralized ethos, and frankly, its anticipated challenges from legacy systems.
Ultimately, what this debate really reveals, I think, is that the S&P's decision isn't just about MicroStrategy. It's more like a barometer, showing how far traditional finance is willing, or maybe able, to stretch its definitions of value and transparency when faced with truly disruptive assets.
Exactly. The question isn't just if Bitcoin companies can join the club, but how the very frameworks of inclusion might need to evolve or risk becoming less relevant if they genuinely aim to reflect the future shape of the economy. There's clearly much more to unpack here.